right, welcome to Dividend Stockpile, where we focus on everything dividend and income investing related, from individual dividend growth stocks, dividend ETFs, income ETFs, option selling, and what we were discussing today, closed-end funds. To help me with that discussion, I'm happy to introduce, even though it may not need much of an introduction, Steve Selengut. Steve is a private investment portfolio manager with almost 50 years of experience managing client funds. He's also the income coach, teaching his clients how to produce more income in their portfolios, and is the author of a great investment book called Retirement Money Secrets, A Financial Insider's Guide to Income Independence. Steve, thank you so much for coming on to the Stockpile. How are you?
Fine. I'm great this morning. It's a pleasure to be here with you.
Awesome. Thank you so much. So we have connected over a couple of Facebook groups and communicated that way. And you always provide, excellent advice, very consistent approach to investing. And you do have a relatively unique in the entire industry approach to investing. So can you tell the audience a little bit about yourself and kind of your high level approach, and we'll dig into a little bit more as we go.
Okay. Well, the approach is one that's been developed over the course of, since I was 25. So it's almost 55 years now that
Wow.
I've been investing, and somehow, and I'm going to tell you how I got involved from income from day one. I mean, it was on my mind, and I guess it all started growing up. My dad was a real estate developer and contractor and builder, and he had what we learned about in college economics was a vertically integrated operation. He had everything from the lumber yard that supplied the materials to the contractors who worked for him, to the insurance coverage after the fact sales on the buildings and vehicles of his customers. He had 6 sources of income: rents, insurance premiums, the lumber yard, the building, the houses he built himself, the sales of property, and the rental income that was coming in. When I started investing in 1970, I was actually presented with the results of all the money I had saved from jobs during high school and stuff like that, and not going to an Ivy League school like my brother did. I got a big bonus for not going because my dad didn't have to spend all that enormous amount of money to do that. I did go to college, though. I don't want you to think I'm not educated. I am. So the result was his attorney, who did his investing for him with regard to the stock market, put it what we used to call stock certificates. I don't know if you're old enough to ever touch the stock certificate, but I got these a manila envelope full of stock certificates dumped on me, and it was a wonderful feeling, and it was worth a lot of money, and they were all dividend paying stocks, every one of them, from the oil companies to General Electric to Sears was in that category at that time. There had to be 35, 40 different companies. Most of the Dow companies were there. And now it's all on you, kiddo, is what he said. Don't lose it. So I got a broker, and we looked at everything, and I started seeing the income coming in because I deposited you had to sign the back of those things, and it was just like the title to an automobile. That's how you negotiated it. So we put them all in, and I started watching them, and she taught me a lot about. She was one of the first persons I've ever heard say market cycle.
Okay.
She ever said, these things go up and down. She was an older woman, and rare in the industry at that time as a broker. And she said, just take a look at these charts, and you'll see that they've gone up and down and up and down, and pretty much paid the same distributions. Most of them raised their dividends every 6 quarters or something like that. So they're all dependable companies. You can tell they're good companies because they pay you and
Hmm.
so on. So, and so I said to her, well, what if we started when we had a down cycle, we sold something that was up and bought something that was down? What if we so instantly we started trading, and the rest is history. And within 5 years, I was making 4 to 5 times more than my salary in New York City, and I just said, "This is it. I'm going to get a couple of friends of mine to hire me, and I'm going to start investment management."
That's
And
awesome.
that's the history. But the income focus
Mhm.
goes way back to my youth. You know,
Awesome. No, obviously, you know that I'm an income investor myself,
right?
dividends, ETFs, income ETFs, closed-end funds. That's my primary focus. I'm building up my portfolio so that I hopefully never have to use the the principal, the shares. I'm always looking to use the income to live off of, and then have those shares pass on to my children. I have 4 children, so
Mm,
I'm hoping to be able to live my lifestyle off of the income that I produce out of my portfolio, and then pass on the stocks and the shares to them. So income investing is absolutely my primary focus, and it's very appealing for those purposes. So obviously you started off at with individual companies, and that's pretty cool that you had the stock certificates themselves. I
yeah,
really, I really wish they still gave this to you. I think you have to pay a couple $100 for the broker to send it to you now. But I would love to have given my kids, a share of a certain company just so they could have like physical paper. Because I think it makes it more real and more tangible when you have it physically in front of you as opposed to just a number on the screen.
yeah,
Um,
I agree.
so how did you get introduced to closed-end funds, and was it an aha moment or was it like a transition?
It was it was one of each.
Okay.
It was one of each. Um, I actually early on when I was just basically all my equity side of my investment portfolios, and I began managing to the point where I had, you know, at the end I had 110 million under management. So I had a lot of people I was doing this for, and they all had their own asset allocations and their own portfolios. But everybody had an income allocation. There was always at least 30% invested for income. And back in the day, you only way you could do that was tax-free municipal bonds. I mean, actually buying the bonds and
Mhm,
corporates. Corporates were more difficult, I thought, and but they did have corporate unit trusts and Ginnie Mae's
mhm,
that you could put clients into, and you got your principal back and the interest, which I found an attractive thing because you could reinvest and so on.
mhm.
Um, but I was in the equity side. I discovered petroleum and resources, and I didn't even know it was a closed-end fund.
Okay.
That was the name of it back in the day, and it goes back forever. And I found it because sometime during a time when I was doing all the oil companies were hot, so to speak, and
Okay.
they were being taken over by T. Boone Pickens and other
Mhm,
guys like that. I was looking, I was just doing some research and somehow I happened upon petroleum and resources. And I looked at it and I saw that it was something I didn't even realize it was closed end fund, that
okay.
it was a fund, a company that invested in the exact same companies I was investing in. And I looked, and its dividend history was uh, minimal quarterly, quarterly, amazing year end dividend. You know,
Okay.
Instead of 10 cents, it was dollars
Mhm, yeah.
that this thing was paying. So I started buying that in the fall, just waiting for them to announce the dividend. And then I would basically, I'd wait until the price went up enough that I was getting most of the dividend. I sold it. And then I
Okay.
do it again the following year. But I didn't even know it was a CEF.
Okay.
But on the other side, when you trade, when you don't trade, in those days, you didn't trade um, fixed income securities. The only ones you could occasionally were preferred stocks, but with bonds, you pretty much held them.
Okay.
You pretty much held them because they were a lot of work to own. And to diversify a portfolio was really difficult
Mm-hmm.
because the pricing, the smaller number of thousands you bought in bonds, the higher the spreads and because they like to trade in 50,000 lumps, and I wasn't big enough to have 50,000 of anything in any one portfolio. And then you held them, and the dividend money came in consistently. That was not a problem. Well, I finally discovered that this PEO was a closed-end fund, and I looked at it, and I looked up closed-end funds, and I saw other names and other numbers, and I just happened on them, and I said, "Wow!" And this was a eureka moment, really. Holy mackerel! I can buy a portfolio of municipal bonds,
Mm-hmm.
and it's yielding higher than my individual coupon bonds. Wow,
Yeah.
And then what else do they have? And then they had everything. And I started to see this. So I communicated with my clients. And I said, we're moving from this type of investment. If I can get $1 profit on one of these muni bonds, I'm selling it and I'm getting you a closed-end fund that's paying more.
Yeah.
And when then you realized that this whole liquidity problem that was associated with fixed income investing disappeared.
Mm-hmm.
You could trade closed-end funds. You could be trading munis. You could be trading government securities, mortgages.
Mm-hmm.
You could be trading all this stuff just like it was a common stock. So that happened, well before the turn of the century, late, in the 90s,
Yeah.
the late 90s. By the end of the 20th century, I probably had a few remaining Ginnie Maes that hadn't run their course yet, and a couple of unit trusts. But as they disappeared, by the time I quit, I didn't have anything other than income closed-end funds in those portfolios, and a lot of them, and
Yeah.
myself included. So that was the real eureka moment. Then there was it was almost a forced entry. I mean, I made my career, my lifestyle in the stock market,
Mm-hmm.
trading the best companies in the world. I mean, we developed what we called a group of investment grade value stocks.
Okay.
We call them, and in order to become one, you had to be traded on the New York Stock Exchange. You had to pay a dividend. Had to be rated B plus or better in the Standard and Poor's guide, which went out of service just in 2018. Or something like that. They ended that, and those were pretty much the requirements to get on my list. Oh, it also had to be over $10 a share and under $80 a share.
Okay.
So then we have the financial crisis.
Mm-hmm.
And I'm trading these things forever, and the same names over and over again. I think Royal Dutch and now Shell Oil. I traded it probably 1,000 times in my career. I don't know. So all those types of companies. After the financial crisis, I found, first of all, the closed-end funds. When interest rates started to go down, they skyrocketed. They hit new all-time highs way before the S&P or anybody else got there. So that was a good lesson learned, about them. And I was taking profits the whole time. In the stock market side, the problem became with investment grade value stocks, my parameters were you didn't buy them unless they were down 20% from their 52-week high.
Okay.
And you never held them for more than a 10% profit. 10% was my target with stocks. Well, the profits started to come. They came back quickly in 2010, 2011, as interest rates fell and so forth. But the problem was that when you looked for replacement parts, there weren't a whole lot of things down 20%.
Yeah.
And after a while, there was almost none. And then the ones that were, you said, whoa, wait a minute. I've got like a universe, maybe 250 stocks, and only 3 of them are down 20%. You don't want to buy them.
Yeah.
not under those circumstances, because everything is up. So I started moving into at that point I started moving into closed-end funds because I was owning the same stocks.
Yeah.
All the dividend stocks, all the investment grade value stocks were in these closed-end equity funds.
Mm-hmm.
And you didn't have to, you knew they were priced too high, so you didn't buy a lot of them. There were so many. I have almost 100 of them on my selection universe,
Mm-hmm.
and I developed that universe very early on, and so I got bigger. My portfolios got bigger and bigger in the terms of the numbers of securities that were there,
Mm-hmm.
but they didn't need to be watched like individual stocks.
Yep.
Because so what if one went down or even went out of business? The impact when the manager had 150 or 200 different companies was minimal. So it
Exactly.
became a much safer, much higher dividend totals, just as easy to trade. It almost seemed to me to be a no-brainer to move into the closed-end equity funds after that. So I haven't owned an individual stock now. It's got to be since 2000 and 2011, 2012.
Okay. Yeah. Yeah.
Yeah.
I was investing during that time, so I definitely remember. Everything was horrible, and then everything came back, and it was like you couldn't find any value for a while there. So,
Mhm.
yeah, totally agree. So, you've definitely touched on a lot of the aspects of closed-end funds, but for someone who has no idea what they are, can you kind of give a high-level closed-end fund
Yeah.
101 type of look
I
at it?
think I think the most important thing about closed-end funds is to know that they're not the same type of animal
Mhm.
as ETFs, mutual funds. They're closer to what common stocks are. But there's the big difference between them and all of the others is that they're trust vehicles. They're pass-through trusts, just like when you get to be my age, just like you've set up for your grandchildren.
Mhm.
They're going to get this amount of your money, and it's going to be in trust till a certain age, and they're just going to get the income from it.
Yeah.
Well, that's what these things are. They have to give out 95% of their income to their shareholders.
Mhm.
Clearly, common stocks don't do that, nor do ETFs or mutual funds. The three of them, their focus is to grow the market value and give back value to their shareholders that way. But they never tell their shareholders you got to sell it in order to get the actual value out of it. So that's the major difference that people have to understand. These things are designed to give you spending money.
Yep.
And and as you know, I've made good use of that spending money over the years.
Yep.
So so that's the biggest difference. Otherwise, they trade just like common stocks.
Mhm.
They do not trade at book value, just like the stock market. No companies sell at their book value.
Yep.
They're either above it or below it. Closed-end funds are the same way. The price is dependent on demand, supply and demand, and the book value is a function of for just how much inventory you have if you're a company or how many properties or this, that, and the other thing. What's the value of the bonds relative to interest rates is what determines the NAV of a closed-end funds. There is no effort on the part of closed-end fund management to equate the price to the net asset value. In that sense, they're much different than both ETFs and mutual funds, which mark to NAV every day,
Yeah.
every day. So there's a big difference, and a lot of people go into closed-end funds and they're focusing on net asset value instead of price and yield. My focus is yield and price. I don't care about net asset value and stuff like that.
So, to just dig in that a little bit more, because the underlying net asset value and the stock price of the closing funds can vary, there's times where it's trading at a discount, and also trading as a premium. So
Right.
can you talk a little bit about that and how that would work?
It just happens. There's a couple of them that I could name without having you think it's a recommendation, anything like it's a Gabelli fund, Gabelli utility fund. It's traded at almost a 60% premium ever since it was issued. But its distributions have come out every month, just like everything, like clockwork. It doesn't matter so much. Um, there are times people could say, well, yeah, if I buy it at a discount and it goes up to NAV, I can sell it at a profit. Sure.
Mm-hmm.
But if you buy it at a premium, it goes up some you can sell it at a profit too. So, you know, uh, I'm the type of guy that I develop just like I had that investment grade value stock um, elimination system. I
Mm-hmm.
do the same thing with closed end funds. There's only about 400, 420, 450, I don't know. And I've developed universes of the ones that are mainly income focused, the ones that are mainly equity focused, and a third one that's just tax free munis.
Okay.
Do you know tax free munis right now? I have 50 of them in my universe, and the average yield is over 6%.
That's amazing. On a muni.
Today's price, actually, it's probably a little more since um, the the uh, the thought that interest rates are going to go down further has kind of subsided right now. So
Mm-hmm.
so prices have fallen a little bit, so the yields are even higher.
Yeah.
But it's amazing. I mean,
Yeah.
you never could get that in the old days in buying individuals.
Exactly.
You could, but they were always redeemable. So back in the 80s, when I bought a 12% um, New York, New Jersey Port Authority bond yielding 12%, I was just, I don't think I got 6 payments on that thing before it was called when rates went back down.
At that rate, they want to pay that off, and so they can refinance to a lower.
Exactly.
Yeah.
Exactly.
Yeah, so one of the great things about closed-end funds that I love, and I do invest in, probably a half dozen right now, but I've been trading them on and off for quite a while, is the higher yield. To your point, they have to distribute a lot of their income to the shareholders, so it is mostly an income-related investment. So those who are looking for the higher yields and the income now, closed-end funds can definitely be beneficial. Just for instance, something on the utility side, if you do a traditional ETF like XLU, you're going to get probably a 3 or 4% yield right now. But if you do a similar closed-end fund, let's just say UPG, which is the Reeves utility, you're going to be looking at 7 to 9% yield. So if you're looking for that current income, closed-end funds are definitely an area to focus on.
Exactly.
Awesome. So I guess with closed-end funds, there's two basic camps of how people invest in them. One is more of the buy and hold, just collect the income as it comes in either on a monthly, quarterly, or yearly basis. And then there's those who actively trade in and out of closed-end funds to take advantage of capital appreciation and things like that. Can you kind of explain why someone would do either and which one is your primary focus?
Um, Actually, yeah, there are two streams of income, and I think it's in my experience and for what I was doing in the past, it's always been that way in all types of securities. I always recognized that profit taking stream of income as a second source. The base I call base income the distributions or dividends you receive.
Mm-hmm.
And it's base because you can depend on it regardless for the most part. And with my selection techniques and quality, diversification, safety, and all that stuff, you can really depend on them, whether it's stocks or income securities or closed-end funds. So that's the base income, and you want to try to grow that every year. If you can reinvest as much as 30% of the income you're receiving and reinvest it selectively, you
Mm-hmm.
can grow your income every year.
Okay.
Okay.
You're taking some of the income to live off of and then reinvest 30%
Right.
to grow your wealth over in your.
So, the more you can reinvest, the faster you'll grow the income. So that's one type of income and one stream of income.
Mm-hmm.
The other stream of income is the profit taking stream of income. Recognizing that closed end funds are not designed to grow in market value. they're not going to be the next NVIDIA.
Mm-hmm.
They're not even going to be one of those long-term guys like Microsoft.
Mm-hmm.
In my 260 odd closed-end funds, including the tax-frees that I invest in, the highest priced individual one is $48.
Okay. Yeah.
The lowest price can be down as little as $1 or $2.
Mm-hmm.
But if it's been there for 15 years and still paying an 8% distribution, that's fine. And it's great for small accounts.
Yeah.
You know,
Yeah.
for your
Yeah.
the $2,000 you give your grandkids each Christmas, to invest. So anyway, so my feeling is, and this year, 2021 was perhaps the best example.
Okay.
And that's what we did for our clients that year. And this is on a starting point of about 98 million at the beginning of 2021. For the year 2021, we brought in about 7 million in distributions.
Okay.
Which is what? It's not 10%. It's maybe 7% or so.
Mm-hmm. A little bit over 7. Yep.
But the profit taking brought in another 7 million.
Wow.
So $14 million on 98,000 is a pretty good lump, and it's in your pocket income. It's not just change in market value, because as we all know, 2021 turned into 2022, which was a down year in the market. So, and the market today, even at near an all-time high, is still only about 5 or 6% per year above where it was back in 2021.
Yeah.
And at the same time, we who are dividend focused, your dividend stocks had generated probably that much,
Mm-hmm.
6% a year.
Yep.
And CEFs have generated over that period of time over 10%.
Yeah.
That's without profit taking.
Exactly.
And there's always something going up. In my book, I talk about diversification, and to most people over the years, and even in your textbooks, diversification has always been a risk minimizer, or a defense against risk, against financial risk. I've taken diversification, I've turned it into an offensive weapon.
Okay.
I've weaponized it, so to speak, because these closed-end funds are in every possible sector.
Mm-hmm.
They have total global diversification. They have anything positive going on anywhere, and of course, anything negative as well, is going to impact the prices of your closed-end funds. The biggest influencer is interest rate expectations. But other than that, individual sectors have the same types of effects as they do on a regular stock market. So I figure my goal is to take a profit every day, at least one profit in each of my 3 accounts.
Okay.
Today I wasn't able to do that in my IRAs, but I got about 8 or 9 done in my personal account. But I take profits every day I can. A day without a profit is like a fine meal without wine.
Yeah. So if you're taking profits, you're locking in that income, you're locking in those gains, and you don't have to rely on the stock to keep it up.
Right. It's doing 2 things though.
Okay.
Because think about this: if there aren't a lot of profits in your portfolio, that means overall there's a lot of red in your portfolio.
Mm-hmm.
And if you vetted all those securities and they're still paying the 6 to 10% dividends, if you have any small profit and you sell like a $12,000 position, even if it's only got $1 profit,
Mm-hmm.
that's 12,000 of capital that you can put back in to the ones that are down 7 or 8%.
Yeah.
And you reduce their cost and you increase their yield.
Yep.
So there's that new capital is just like, getting it from your rich uncle. He sent you a check, and you reinvest it.
Yeah.
So that's the type of income. Those are the 2 types of income I do.
Okay.
I go for the capital gains, and I go for the growth of the regular base income.
Yeah. Nice. So closed-end funds obviously you're a big fan. I'm a big fan. Lots of positives to them, but some detractors out there, or some people say that there's risk to closed-end funds, or they're not as efficient or as good as an ETF. So can you explain? One of the big things is usually the fees that people are concerned with.
Yeah.
Closed-end funds can have anything from 2/3% up to 2-3% sometimes management fees.
Mhm.
Can you explain kind of how you overcome that with your clients and how you overcome that personally?
Well, I've never paid a fee.
Okay, a good approach, good way of looking at it.
I mean, I've never paid a fee to a closed-end fund.
Yeah, true.
I've never seen it on my account statement. There's never a deduction.
Yep.
What,
And the reason
what,
for that is
because they're paying out all their income net of fees.
exactly.
Net of
Yep.
fees. So that when I'm getting my 8% distribution, that's after fees. I
Yep.
don't, and that manager is working.
Hmm.
Now, if he is trading those securities, he's selecting those securities, he's producing. You may have a 10% yield at the end of the year. You're going to find that when you report your taxes, that 30% of that was long-term capital gains.
Because they're
You
actively
know,
working.
that type of thing. Whereas I kind of lost my train of thought there. In
The
in
fee.
in the other ones, you're getting 3% or 4% after fees. You're not
Mhm.
paying fees there either.
Yep.
But it's so it really, that's not an issue. The fees are. Let's go back. Let's talk about the investment management universe.
Okay.
How did I get paid when I was an investment advisor? Unfortunately, I didn't get paid by how well I was growing my clients' income.
Okay.
Okay. I got paid based on the amount under management.
Hmm.
So when we had corrections, when we had the crash in 87, when we had the dot-com bubble, we had the Great Recession, even the COVID scare, right? My note to my clients was there's good news and there's good news and there's good news.
Okay.
Prices are down. When I reinvest your distributions, we're going to get higher yields.
Yep.
The other good news is prices are down and I'm getting less in fees.
Yeah.
You're paying me less to manage your money, and I'm still doing the same job.
Yep.
I'm actually working harder then because I got more to do.
Yeah.
So that's the thing. It's there's no incentive. There's no incentive, and there are people who they'll go out and they'll say, well, they use leverage.
Hmm.
So does every other company in the world. So
Yep.
do most individuals use leverage. How else would you buy a house?
Yeah.
You know,
Exactly.
they use leverage. They have the high fees. I don't know what else they criticize. They return capital.
Hmm.
That's the third biggest criticism. Oh, they're giving you your own money back. It's not your own money back.
Yeah. That's not how it works.
That's not how it works. And think of the same guy who's talking to you there on the other side of his mouth. He's selling you an annuity.
Talk
What
about
does
fees.
annuity do? Gives you your own money back.
Yeah.
Okay. So, that's the type of thing.
Yeah. So I mean, for a individual investor or end user investor, it's really the total return or the income that you receive that should make your determination. If you're getting charged 1%, but they're providing you the income or the returns that you're looking for, why does it matter if they're charging 1%? As opposed
Exactly.
to an ETF, if you are paying 0.06%, like on some of the dividend ETFs, but they're underperforming or not giving you enough income, what's the point? You're still
Yeah.
making less than what you could. So that's why I've never had any concern with paying the management fee related to closing funds, because it does provide that income that's very usually like at least double, if not more, of the income for the same
Yeah.
dollar invested. So for an income investor, it makes a lot of sense. Obviously, there's some good closed-end funds and there's some not so good ones. So you have to still do your research and
Oh,
determine
yeah.
if
I
it
do it every
fits.
month.
Yeah, exactly. So, but just the fact that they have fees, a lot of people are scared away. But if you really think about it, to what you're saying, it's not like you're paying those. As long as the performance is what you want, why not?
Right.
Um,
Exactly.
so being in the industry so long, why are closed-end funds not as popular? I mean, they've been around for longer than ETFs and mutual funds. So
Right.
why have they not become as popular to the mainstream?
They're just not sexy.
Okay.
They're not going to, you're not going to have that price explosion. And as I said before, there's a little bit of selfishness in it too. They're not designed to grow in market value. They're paying out 95% of their income.
Mhm.
Would any company, if it had to give its shareholders even 50% of its income, which none of them do that much,
Mhm.
they wouldn't grow as fast.
Yeah.
And it's that growth of profit and that growth of territory and their control of the marketplace, their sales numbers. That's what grows their stock value.
Yeah. No, that definitely makes sense. All
Yeah,
right. Well, you mentioned earlier about your book, and I see it there in the background. I have a copy of myself right here. Hopefully, everyone can see it, and this will blur it out a little bit.
it is.
Oh man, find it. So it's Retirement Money Secrets is the name of the book, and the subtitle is A Financial Insider's Guide to Income Independence. So I've read through the book a few times. I really enjoyed it. I love your approach to explaining why it would make sense to be an income investor and why it makes sense to invest in closed-end funds. And you do it through a recollection of a client you had, the Cranes, and how you taught them to look outside of the traditional grow your balances, and then when you retire, withdraw 4% or whatever your number is,
Mm,
and live off the balance. And you show them how to transition to an income minded or closed-end fund minded investment strategy to provide the income that they're looking for in retirement. So obviously that's a very high level, but can you explain a little bit more about what the goal of the book was?
well, the goal of the book was to really introduce income investing and specifically closed-end fund income investing to more people to let them appreciate, as I learned so early on, that income is really the most important thing out there. It's, why do you look for a second job, or why do you look for a raise? You know, you want to get more money, more spending money.
Hmm.
Um, why don't people take profits? They fall in love with things when they don't want to pay taxes. Instead, would you say no to your boss if he gave you $100,000 bonus because you had to pay profits on it? No, of course not. Well, profits are the same thing. They're illusory, right? They're there one day and the next day they're gone.
Yep.
It's like that dollar on the, or $100 bill on the sidewalk. You're not going to walk by it.
Yeah,
You got
exactly.
to pick it up when it's there. Um, I have people who, you know, I got a call from a coaching client the other day, and I had just written to everybody, this is why we take, because we've had like 4 days in a row where interest rate sensitive stocks
Hmm.
and have been down a little bit because the Fed's not so clear where it's going to lower rates again or not.
Yep.
So prices have fallen because of that. And those little bits of profits, those 4 or 5 and 6% profits, are now gone.
Yep.
you know and that's why I wrote him a note. And I don't know, Jeremy, if you're in my retirement income group or not, but if you were, you saw it.
Yeah.
This is why we take profits.
Yep.
'Cause-
Absolutely. I mean, you think about it, if you're relying on income from your investments or you're using the money from your investments to live off of, and we go through a COVID or we go through a 2008 and 2009, the S&P 500 went down almost 50% over that stretch. If
yeah,
you're selling off your assets to live off of and you just took a 50% haircut, it's really hard to come back from that. You have to reduce your lifestyle, or you have to wait longer to use the money and wait for the market to come back. But with income investing, if your focus and your goal is how much income I can generate, it doesn't really matter what the stocks do in the short term. It could go up or down
exactly.
as long as the money's coming in. That's what you live off of. What is it? Capital appreciation never paid the bills, type of thing. So
Right,
you have
exactly.
to pay the profits. You have to get the income in your hand in order to live off of it. So everyone who's like, let's just put all the money away, stock it up, you get $3-4 million when you retire, and then sell it off. That sounds great, but what if the market's in a downturn during
Exactly.
you need it the most? And so income investing kind of negates that as long as you're, obviously strong companies you're investing in, or closing funds with a solid history. You're going to continue to receive that income even if the market goes down. And that might even be a better situation because the investment managers can buy things at a lower price and
Hmm.
get more income. And your existing investments, if you're adding more money to those, the yield is higher and you can get more income. So it's a different approach, and I think a lot of people are just stuck in this mindset of the corporate investment world of, stack assets and then sell them off and then die. That's what most people are taught, that, there are
Right.
different ways, and you do a great job in the book explaining why someone should look at that type of investment.
Yeah, and it really doesn't take a whole lot of effort once you isolate your universe of what you're going to select from, and you don't have to take every profit every day like a nutcase like I would do. But as long as you're on top of things and you're not just ignoring those profits,
Yeah.
you and and all the hype out there, all the noise about the market new all-time high, you've got some profits. Go there and take them. You
Yeah.
know, so it's kind of easy to manage, and a lot of people begin to like it.
Okay.
And I've got one coaching client that every time I speak to him, he says, I've really become an addict. I'm a profit addict.
There you go.
I'm taking 30 or 40, this was a few months ago when you could do that.
Mhm.
And I said, I don't do that many. I calm down a little bit, 3 or 4 or 5, 6 maybe, but
Yeah.
you don't, yeah.
You got to take advantage of it. Yeah, I mean,
Yeah.
to the point, there's so many individual stocks that, earlier this year they were up 30, 40, 50%, and now they're flat for the year. And if you never took those profits, you didn't get anywhere. And so,
Exactly.
yeah,
There's no benefit at all unless you take that profit.
exactly, totally agree. So
So
you
the
mentioned,
thing, so
oh,
the thing to do for anybody, and regardless of what type of security they're in, is treat your securities the same as you would as if they were goods on your shelves of your department store. You
mm,
set a price. Everything's got a price tag, and
mm,
that's your profit margin.
mhm,
Make it a reasonable profit. Mine's 5% on closed-end funds. It was 10% on stocks, but I never ever said no. I'm going to wait for tomorrow and it'll go up higher.
yeah,
Take your profit at your target. And depending on where you are in the market cycle, you can adjust your target a little bit up and down.
mhm,
Like right now, today, any profit's okay with me.
okay,
You know,
because of where the
three
price levels
three
are.
weeks ago, I was taking profits at 3 and 4%.
Mhm.
You know, so yeah, you just have to take what the market gives you when it gives it to you.
Yeah, that definitely makes sense. So for someone who is interested in closing funds, how would you not recommend, but how are some different ways people can start investing in closing funds? Is it like they'll sell everything and move into closing funds? Is it transition? What do you think?
It's a transition process depending on the size of the portfolio. Right now we're a couple days before an election. I'm certain that half of the people that are listening to us are putting some cash away because they want to see what happens. I don't do that because I just as soon invested at 10%. It's
Yep.
still going to be 10% if the market goes down or if the market goes up. If it goes up, I'm gonna take profits, blah blah blah.
Yeah.
So I don't hold money around trying to time the market or anything. But a lot of people are
Yep.
transitioning. Is different in taxable versus tax-free
Mhm.
investments. In tax-free or tax deferreds, I always start with the biggest profit when I transition somebody, or when I used to do it for people back in the day. I take the biggest profits, and I'd look at anything that I thought was a dangerous or a speculation type situation, and
Okay.
those are the ones I get rid of first.
Mhm.
Move them into closed-end funds, and the next wave would be if they had huge positions. Um, I start to trim them to get
Mhm.
rid of some of the excess risk associated with having too much invested in things. So there's lots of ways to do it. The book gives you some suggestions on how to do it, and then you can always find yourself a coach that'll help you, you know, develop a transition plan. And that's a lot of what I do,
Yeah.
is
So
to develop transition plans. And then the last thing that I do, um, getting the universe set up and monitoring it and developing it and keeping track of it can be time consuming. So I do provide a service of an annual subscription to my universes, so they know, um, these are the ones I'm using in my portfolios, and I do own everything in those universes
right.
myself.
So for everyone who's watching, it's theincomecoach.net, correct? It's your
Yes, that's it.
So if you want to reach out to Steve to get some insights on how he would approach that coaching, definitely reach out there. You can also order his book through his website as well, so check that out. I think it's a direct link to Amazon to make it super easy to order right there. So outside of working with you and utilizing your expertise on the selection universe, what are some other resources out there that people can go look for more information about closed-end funds?
The website that I use for all of my research, I've been doing this for a long time, so I don't use the tutorials they have, but they do have some, and they have screening things so that you can put all of the taxable income in different orders based on whatever you want to look at. I use it by the yield, and so on. So it's really good. I've liked it a lot. There's another one called Dividend History. Oh no, it's called dividendinvestor.com,
Okay.
and it's good for finding histories and stuff like that. But those are the only two I use. I don't use stuff like Morningstar and other rating services because they tend to rate things based on market value of the security and say, oh, it's not as good as this or that, because of its price range. Price range really isn't an issue with closed-end funds as it is with individual stocks and things like that. So those are the sources that I use.
What was the first one again?
CEFconnect.com. And that has a lot of resources in it. It's sponsored by Nuveen, and they're a big provider of closed-end funds.
Yeah.
So that's good.
Yeah, another site that I like is CEFchannel.com is one I use.
I've heard of that one, yeah.
Yeah. And then my favorite investment company is BlackRock, and so they have a whole closed-end funds investor resource page as well. So if you want to get some information about closed-end funds, both theirs and just general knowledge, you can go to that one too. So there's a lot of good resources.
Yeah, right. Yeah. I use a lot of BlackRock funds, particularly in the municipal area.
Okay.
Yeah.
Yeah. So for BlackRock, I have BST, which is their science and technology closed-end fund. I have BDJ, which is their dividend focused closed-end fund. And I'm sure there's a couple others that I forget. Those are really good. Columbia something Needle is another one. Another company that's really good. I'll have to get the name of it. And then the Reeves Utility Fund is a very popular one that held out for a long time. So yeah, some really good ones out there. Not a recommendation, just some that I've used in the past. All right. So I really appreciate all your insights on closed-end funds. Before we end, I just want to kind of get to know you a little bit better. So you said you retired from the investment management space a couple of years back. So how's life been being quote unquote retired from your corporate?
Retired. When you write a book and one that's actually had a pretty good response, and you start doing podcasts, retirement becomes more like, I guess it's almost like a band with a gig, a gig type mentality where you're going out and having fun.
Yeah.
And I think you can tell that I kind of enjoy this kind of conversation and on podcasts and also the coaching. Coaching is really interesting. You meet a lot of interesting people. I mean, I'm going to be interviewing a guy who works for Blackstone.
Okay, nice.
Later today, So he's come to me for some information. He's not an investment manager with them. He's got some other job,
Okay.
So it's just you meet so many interesting people and from all over the world. In this environment. So it's really
with your expertise and your background, you're the perfect person for someone to reach out to for that coaching. So that's awesome. So your retirement is almost like your part-time thing, and all the other work is the.
Well, I'm 4 days a week now. I don't have any more appointments on Fridays, or I haven't on weekends. Yeah. So it's I am semi-retired, you might say.
There we go. And I noticed on your website, and I think discussions we've had in the past, you like to travel. So any upcoming travel plans you have right now?
Yeah, we got four booked. One is that Grand European Viking trip we're doing in April.
Nice.
And then we got Japan and India. Wow. And we're doing a trip around from London all the way up to the north of England and into the Scottish islands and stuff like that. And that one actually winds up in Norway.
Oh wow.
I believe it in Bergen.
Okay.
Bergen.
Yeah. Bergen, Norway. I've never been. It's always been on my list.
It's a great. We were there
Looks.
so many years ago, but it
Yeah.
was great then. I'm sure it's even better now.
Yeah. No, that sounds like the dream. So, is that your focus in retirement, if you will, is the travel? Is
We're
that
gonna, yeah, we've got Antarctica. We haven't booked yet.
wow?
And then we might if we, we're getting up there in years, so we might get to the point where our travel will be all right. This month we're going to go get a B&B in Rome
Yeah.
or in Paris or things like that we might do.
Yeah.
But yeah, I don't think we'll stop traveling until we have to.
Yeah, that's my wife's dream, is just to get like a 2-bedroom apartment or something in Paris or Rome for a month, and just hang out there. And
Yeah,
we call it slow travel. You're immersing yourself in it as opposed to trying to hit all the highlights in the 4 or 5 days you're there. So that's her dream too. So we'll get there. We'll get there one day. So
yeah, that's what we're looking forward to.
our investment income will help us do that. So
Right,
that's the whole
exactly.
purpose for it all. Awesome. One last question. I know your primary focus is closed-end funds, but do you have any kind of favorite companies or favorite investments you have outside of closed-end funds?
I was trying to think of something.
Mm-hmm.
I started with dividend stocks.
Okay.
I think dividend stock investing is for the average person, the non-closed end fund investor. I think if you do that, dividend stocks, you're not going to have nearly as many problem children as you would if you just went after anything in the stock market and tried to pick the next, humongous winner.
Yep.
I've never bought any security in my life that didn't pay something.
Yeah, that's great.
And
Obviously, that's
and I'll stand by that. A favorite, the favorites, yeah, Royal Dutch was my first profit ever, and I'll thank it forever.
exactly,
And
special place in my heart. Yep.
and everybody's going to have some favorites like that. I mean, and since I was managing for so many people, my list of favorites would include Pepsi and Coke, and would have been several of the oil companies and healthcare companies and stuff like that. But mainly, almost exclusively. I mean, these were names you knew.
Mm-hmm.
You walk down the street and say, "Oh, there's one. I own that company." That type of thing. That's what you want to do, I think.
Exactly. That's one of the great thing about dividend stocks is you can see their businesses out in the world. Like, you understand what they do, and you use their products and you can relate to them. So it's a neat
and,
feeling.
and the other thing about dividend stocks, and the reason it's so important, is that it's a clear indicator when they're having problems.
Mm-hmm.
If they don't ever want to cut a dividend.
Yeah.
And if they do, that it's a serious decision and something's going on, and it might be time to bail out.
Yep. Exactly.
So it's an indicator that you don't have on the NASDAQ.
Yep.
Almost exclusively. You don't know what's going on. If they're paying a dividend, you know what's going on in that company.
And you can track it by a couple different payout ratios. You can do the earnings payout ratio, the free cash flow payout ratio. You can see when things are getting a little scary, if you will. So yeah, you just have to keep up on it. But I totally agree that dividends are paid by cash in most cases, and if they can't pay a dividend, they're having a cash problem, which leads to bigger problems. So it's a telltale sign for sure. Awesome. Well, Steve, thank you again. I'm going to make sure that I include all your links to all your things in the description. Really appreciate your time. Outside of your website, is there anywhere else people can find you at?
Just my Facebook groups.
Okay.
The Retirement Income Independence Coach is my primary.
Okay. Awesome.
And I have another one. There's a few Facebook groups on closed-end funds.
Mm-hmm.
And mine is the one that says closed-end funds for retirement investing and equity trading.
Okay.
So it's
awesome. Okay. Well, thank you. Really appreciate your time and expertise, and hopefully we'll talk soon. hopefully both in person and on the Facebook group. So,
And on a Facebook group, sure. Great.
excellent.
It's
All
great
right.
talking with you.
You as well. Have a great day. Bye.
Okay.